Hello, future millionaires and billionaires. Welcome to the episode of the Investor Chair, proudly sponsored by Centrix. Today, we are sitting with a man that everyone in the Twitter street love. He gives out the analysis behind the stocks in the JC, the small ones, the middle one, and everything in between to help the average South African be able to take care of themselves through investing and also understand what they're putting their money in and understand the research that goes into picking stocks in the GSE. We are speaking to the man himself today. But remember, guys, this conversation is proudly sponsored by Centrix. If you want to learn more about their ETF, their products, do ensure you click the links on the description of this video. At the same time, guys, do ensure you hit the like button, subscribe button, and leave me a comment. Tell me what you think about today's conversation. Tell me what you think about the points, the topics, and everything we're covering on today's conversation. Not wasting time, let's get into today's video. Future millionaires and billionaires, as I said in the intro, today we are speaking to the man we love in the Twitter space. We always see you on business news. We always see you giving a little bit of diamonds around how to understand the stock market, your favorite picks and all of that. But for me, I don't love introducing people. Every time I have a guest on my YouTube channel, I'm like, I want them to introduce themselves the best way they know how. So who's Anthony? Who's Small Talk Stocks? Who are you basically? Let's start there.
Well, Ivan, thanks for coming to my home this morning. We're sitting here in my living room. We've got CNBC on in front of us. I've been working upstairs all morning on a number of small stocks, like small cap, like Sabcap, Spur Corporation, and Nampak, and also baking Christmas cakes. Because, as everybody knows on Twitter, apart from just doing analysis and looking after a large institutional client base, I have to have a normal side life. So I'm baking Christmas cakes. So who is Anthony Clarke? Anthony Clarke sits here today. Very casually. He's been involved in financial markets for over 30 years, and really, for an analyst, particularly on the JSE, he's been involved in covering one sector of the market for the best part of those 30 years, which is small to mid-cap stocks. Most analysts come into the sector as young analysts at institutions or stockbrokers, and they are given small caps to cut their teeth on, and they rapidly move on to covering larger companies. So it's very unusual for an analyst to cover one specific sector for such a long time. So what that does, apart from giving me a little bit of grey in my hair, is it gives you a sense of history and wisdom, which most analysts and most investors don't have. Because I've been around the 87 crash. I've been around the Russian crisis. I've been around the Lehman Brothers crisis. I've been around the Ukraine story. So you can put all of that context into 30 years of investing and analysing small to mid-cap companies, because the same patterns tend to occur over and over again. So I love the small to mid-cap space, food and agriculture. I spend my entire life visiting companies, kicking the tires, understanding the nuts and bolts of what makes a company run. And more importantly, actually engaging with management as to what they see as the main drivers regarding the companies. Because in many cases in the small to mid-cap world, it can be a small change in the underlying business that could lead to dramatic consequences and an uplift in the share price if you get it right, or consequently, if something goes badly wrong, the share price will crash. So in the small to mid-cap space, sadly for many of your listeners and followers on Twitter and social media, you have to do the underlying legwork regarding small to mid-caps, because you can't rely on what you read in the media, because the information isn't often available. You have to go out and find it. And many people then say, well, how can you find it? The answer is you read annual reports, press cuttings, you attend annual general meetings, and you just be inquisitive. And you can then find out the information which most people, they know it's out there, but it's not as easy to find that, let's say, it would be for a top 40 stock. That's why I cover the sector, because it's slightly harder work, and it's all relationship based.
And that's amazing. I love the two things that you just mentioned. Number one, history repeats itself, and also when it comes to investing to a small cap businesses, you need to be active. You need to take proactive steps to understand the business that you are looking into. And you, as you said, you have 30 years experience in that field. But now let's get into 30 years. Let's talk about your upbringing and how it influenced. Because I love to ask this question, because it tells us more about the person than anything else. Your upbringing, how it influenced the way you see money, the way you deal with investments, and how you moved into the small cap. How did all of that happen? I know it's a bulk question, but hope you are getting what I'm trying to ask.
I'll give you a shortened story, and this is a story that will hopefully resonate with many of your listeners and people watching this YouTube channel. That no matter what your background, no matter where you come from, no matter how you've been brought up, you can make it into the stock market and into the investment world if you work hard and you educate yourself. So in my case, you're seeing this, guy in his mid-50s sitting in a chair talking to you, and you think, he's been around, he has some from a privileged background. It's not the case. My parents got divorced when I was very, very young, very traumatic and very bitter divorce when I was a very small child, split from my family. My mother then remarried. We had no money. My stepfather was unemployed. My mother became a cleaner just to put food on our table when I was 9, 10, 11, 12 years old. We lived in government housing in the United Kingdom, where I came from. And I went to a state school. And I learned from a very, very young age, the only way to escape your background is to educate yourself, work hard, do well at your exams, and then hopefully get into a university. But sadly, because of my background and where I lived, there was little chance for a boy from a council estate with no formal education and particularly no silver spoon in his mouth to get into the stock market. So I went into my family's engineering business and just became an engineering apprentice, working very long hours, knee deep in engine fluid. And my first career for 5 years was an apprentice learning how to make the machines that make cars. So my final project was actually making the bonnet of what is now the Opel Corsa car. I'm going back now to the mid-90s. And then one day I realized that I really love the stock market. I've been investing for myself since I was 14 years old. A family member of mine had given me a small amount of money for Christmas. And I started doing what every person listening to your podcast does. You start reading the newspapers, you start reading magazines, and you start looking for, that's an interesting tip. And my first ever investment was a small company, a penny share, called Bristol Channel Ship Repair. Which
Never heard of it.
No, it's in the UK. It was a docks business repairing ships. But unbeknown to many, in the annual report, this dock company in Bristol, which is quite a prosperous town in the UK, had a large piece of land on the waterfront. And as Bristol was transforming itself from an industrial heartland to more of a residential and leisure area, that land became more valuable. And I thought there was money to be made by investing in this dock company, which might become a property play. And I made a bit of money, and that bug hit me when I was 14. I then started writing letters to local stockbrokers saying, listen, here I am, this young guy from the wrong side of a track, with no formal education, no privileged family. What do I need to do to enter the stock market? And many, many letters were sent. Hardly anybody responded. One guy did. His name was David Cockram, and he worked for a very respectable and old London stockbroking company called Lang & Cruikshank, which just happened to be owned by one of the world's largest banks called Credit Lyonnais, a French state-owned investment bank. And he politely wrote me back, and I went to see him. He said, Anthony, what you need to do is you need to go back to university. You need to study business and finance, maybe accounting, maybe marketing, and then keep on learning and reading and analyzing and understanding the markets, so that when the time comes that you look for work, you actually have something better than a candidate who perhaps has a better background, has gone to a better university, because you have passion, you have energy, and you have drive. That took me the best part of 9 years to do. I quit my engineering job when I was 23. I put myself back through university to study business and finance, specializing in company financial reporting and marketing. Worked very hard to get good grades, despite my background. And then one day when I was looking for a job on the university notice board, there was a postcard: stockbroker seeks junior clerk. Now, a junior clerk is basically the lowest of the low inside any stockbroking firm. You start at the bottom and you learn your way up. So I applied. And I went to London on a cold December day. And I walked across London Bridge to this office. And the guy who interviewed me was the guy who 9 years previously had said to me, this is what you need to do to get into a stockbroking job. And he said to me, didn't I see you a few years ago? Because I have a very distinctive accent. I'm Welsh by birth, but I've lived all over the world. I said, you did, sir. You gave me the following advice to do this, 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 and this. And I did exactly that. He hired me on the spot.
Destiny.
And I got my first job as a stockbroking clerk. And I worked for him for 2 years. And then having learned the trade, in 1994, when democracy came to this country after the fall of apartheid, many people will not know that the Johannesburg Stock Exchange in the mid-90s was the 10th largest stock exchange in the world. Imagine that. Today we aren't even in the top 20 or 30. But back then we were one of the largest emerging markets, and international banks and stockbrokers wanted coverage of this brand new market. Now, I've been covering the JSE for many years because I've got family living in this country. My mother's youngest brother, who was Welsh, came to work in the coal industry, married a local woman, had children, and I was coming to visit him. So I was keeping an eye on the JSE. And as a sideline, on my 18th birthday, I was on the floor of a Johannesburg Stock Exchange at the height of a 1987 stock market crash, and I was hooked. I said, I want to work on this exchange. I want to work on that floor, but I'm not working there now because apartheid is not right. And when the country opens up, I will work in this exchange. That happened in 1996. After the democratic elections in April 1994, in 1996, Standard Bank bought a local stockbroker called Anderson Wilson and Partners. They were my counterparty agent in London. And they said to me, we know exactly who you are. We know what you do. We want you to come and work for us. So in May 96, I packed up my cardboard boxes in London. I arrived in the country with 200 rand, some pots and pans and clothes, lived with my aunt in Johannesburg, and started work at the end of May on the floor of the Johannesburg Stock Exchange for Standard Bank. And from Standard Bank, I've worked for a number of stockbrokers, from Genbell Securities, part of Sanlam. I've looked after money in unit trusts for Sanlam in the late 90s. I've worked for Board of Executives, Nedbank, Barnard Jacobs Millett, the country's leading stockbroker, and then for 10 years for a black empowerment firm. And then 4 years ago, when the empowerment firm closed down the securities business, I decided, with the support of my institutional clients and my financial mail rating, to become an independent. And 4 years later, here we are, being interviewed by the likes of yourself in my house here in Cape Town as I work upstairs, and life cannot be better. Work hard, do well, study, and as you correctly said, fate and karma and circumstance can bring things your way. If you love what you do, you have passion, and you're at the right place at the right time. And that's my basic story.
I like one thing. I'm listening to you, I'm just thinking of words of affirmation. Because everything you said to yourself, you achieved. Even with all the ups and downs, the issues you're facing, but your words, in the beginning you said, I want to be there. You were there. You said, I want to be in the GSE after democracy. You were there. You said, I will be in the stock market. You were there. And that's amazing. Like, sometimes people don't take into account the power of words. Power of affirming what you want and working towards it. But especially in our generation, it's lacking. And I just love that within your story. But now I want to talk about small talk daily, the motivation behind it. Because you said, I want to be independent. I want to start small talk daily. And for me, when I first discovered Small Talk Daily and discovered your work, I was like, who's this white man talking about small caps while all typical white men are there talking about big stock? And here you are talking about the average South African on Twitter, engaging everyone. I was saying, hey, and this is done like this. Why do you, besides just working with institutional clients, the need for you as well to say, hey, let me take care and share my information with the average South African? Where did that passion and motivation start from? Say, I will talk to the average South African. I will have the normal guy on the street. But it's rare to find such in South Africa mostly.
That's a great question. Small Talk Daily as a brand actually started in 1996. So people think that it's this new brand that's been on Twitter for a few years. It's actually been my core brand, marketing the work that I do in my name across every single company that I've worked for. So it doesn't matter who I worked for, whichever institution, it was always Small Talk Daily by Anthony Clarke, and always covering small to mid caps. And I learned many years ago that, I am not representation of this country, and I'm very honest and open. As a white man in his 50s who chose to come to this country in 1996 because I adore this place and I have no plans to leave, despite the challenges that we have as a nation and a country. you have to give something back.
Yeah.
Because I am not the investor of tomorrow. You're the investor of tomorrow.
Yeah.
The followers of the listeners of tomorrow. It's all the young black and coloured and white and Indians out there who want to put money aside for themselves to grow a little nest egg for themselves, to buy their first car or put a deposit on the house. Or more importantly, which I think is absolutely crucial in this country, young people putting money together to pass on to their children and their children's children, to build what I call intergenerational wealth. Yeah. And, let's be honest here, this country does have problems. Not everybody is as fortunate as many of us. Yeah. But a small amount of money in an average family can send a child to school. Yeah. That child who goes to school can perhaps then get a decent job, and then it starts rolling. Yeah. So my motivation has always been to try and educate and encourage the new investors of tomorrow to say, listen, it doesn't matter how much you start to invest, whether it's 20 Rand or 50 Rand or 100 Rand or money that you get for Christmas or birthday or your side hustle. By putting money away, over the longer term, the stock market has been proven to be the single biggest source of wealth creation known for nearly 100 years. Yeah. So if you start saving now as a young person, you can create money for yourself and for your future partner and your children and your grandchildren. Yeah. And that's what this country needs. We need democracy in the stock markets. We need more wealth creation, and more importantly, we need transparency and we need what I call wealth distribution. Yeah. But people can make their own wealth. Yeah. And that's why I do this on Twitter and podcasts like this. Yeah. To give something back, to encourage people out there. It's never too early to start. And if someone like myself, as I said, from a very humble, very working class, average background can do this, then anybody can. Do not let somebody hold you back. Yeah. If you want to do it, you can do it. You just need to work hard and get the right lucky breaks. And that's why I do things like this, and why Small Talk Daily on Twitter extends its reach to as many people as possible. And
that's wonderful. That's wonderful, because one of the key issues when we started this series was, for me, like, we know a lot of people are brands out there. We know them as the face of this, the face of that, but we don't know their beginnings. We don't know what motivates them. And one thing that can make more people take investment, taking their finances more seriously, is to understand the story behind. Because someone can come from a privilege, someone can come from a background, from a poor background story, but the second you understand their story, you see how they influence the way they deal with money. It can motivate more and more and more people. And that's why I'm like, let me push this series. And that's why I'm very grateful also for a brand like Centric to come on board. Remember, guys, the Centric app is available for those who want to invest in any of the ETFs they have. So click on the link on the description of this video to start investing on their app. Now let's get into investing. Let's touch on the first thing you look at when you pick and want to analyze and research a company they chase. What's the first thing you look at? For example, someone say, hey, here's a new business called Ivan Enterprise. What's the first thing, as someone who analyzes business, look at before saying, I will put my money in, or this business is good? What's the first thing that you look at as someone who's in the industry for almost 30 years?
Yeah, I cover a lot of companies, probably between 70 and 80, and I pick up about 4 new companies a year. And the common theme that runs through any company that I decide to pick up is there has to be a very simple story that you can actually pick up on, which you can then relay to your clients. Because I look after the institutional market. Yeah. And that story can be, perhaps there's an uplift in earnings coming, or they're about to do a deal that perhaps could transform the company's potential, or perhaps there's a takeover coming, which again can change perception. So it generally starts with what can be a very simple story, which you have to dig around to try and find. Yeah. I love using direct examples. Nampak now, its market value is 680 million Rand. It used to be a multi-billion Rand large cap company, but as we know, it's got 6 billion Rand in debt. They're currently undertaking a 2 billion Rand rights issue, and the company share price has completely collapsed in the last 12 months. In fact, it's down nearly 50% in the last week. It's trading at a Rand. Now, I'm not covering Nampak, but I'm keeping a very close eye on it for a number of reasons. One, the share price has completely fallen in a heap. Its market value now is literally a micro cap. But it's a micro cap which is the leading producer of aluminium cans in this country that Coca-Cola uses. South African breweries. Anything that's in a can with an alcoholic or a soft drink, they tend to make. They have a near monopoly throughout parts of Africa. Now, if this company were to go bust, who would actually package all of those tin cans and supply them to the likes of South African breweries, Coca-Cola, etc., etc.? There wouldn't be anybody.
Yeah.
So I'm seeing this company currently down in its luck with a huge debt pile, which is currently looking to rescue itself via a capital raise. And I potentially see activists becoming involved because they can see probably a small company with significant potential whose management has perhaps not managed this company well for a number of years, expanded too quickly into Africa, over-leveraged themselves, took on too much debt, and all it needs, as I say, is a good sort out.
Yeah.
And somebody will see that opportunity, and mark my words, I would imagine in the next month or two, if you listen back to this conversation, that someone will have come in and made a cheeky bid for Nampak and will restructure it, will downpay a significant portion of the debt, possibly sell off some non-core assets to leave what is the profitable side, which is making beverage cans, which everybody uses every day, billions of them. You can't simply set up a beverage can overnight. So Nampak to me can't go bust. Because if it goes bust, South African breweries, Coca-Cola, and anybody that uses a can to package a product would not have packaging for their goods. So something will have to give to save this company. I'm not saying I would run out right now and buy for a rand, but I'm giving you an example of a stock which has completely fallen out of favor. Where the underlying business has significant value trapped inside the company. It just needs to be reorganized and rationalized. And at a rand, I'm not a gambling man because I hate gambling because I hate losing money. But I can see that someone is going to come in and say, this micro cap has got potential. It just needs a sort out. And that's one example of what I look at in looking at companies. And they all have very similar stories. There's something that catches my eye, which I think can potentially lead to a revaluation of the business.
Oh, that's very, very, very insightful. And because you said like you look for that one thing that will just be the chain in the overall analysis and understanding of a specific company. But now because I want to touch more into this. I want to fully understand, because as much as you work with a lot of institutional clients, for retail investors in South Africa, what's the one pattern you have noticed in terms of how they invest and how it can be done better? Because I think the retail investment space in South Africa is so new that mistakes have been done all over the place. You log into Twitter, you log into TikTok, you see people doing things so wrong, and sometimes you're like, nah, this is out of line. What do you think is the one thing that the retail investment space in South Africa need in terms of understanding the investment they're making?
Another great question. I find from my Twitter page, I get lots of direct mails from people asking me very simple questions saying, we've just bought this stock, it's gone down, what should I do? And, like yourselves, given the following that we have, we are unable to answer all the queries, otherwise we'd never get any work done. But I often feel that many investors simply buy stocks either on a tip or a recommendation, and they haven't physically done any work as to what this company does, what its prospects are, how the results have been in the last couple of years, and they're buying it because they saw that somebody that they know on Twitter is recommending the stock. You don't know who that person is. You don't know what the qualifications or the credibility are. So I would advise people, before you start buying any shares based on a tip or a Twitter comment, do some research. There are lots of online information sources available. The company's own website is a great source of information on financial and corporate news. There are a number of publications in this country, like the Business Day, the Financial Mail, amongst others, and online services that can give you information. So do not rely on any one source. At least have 2 or 3 different sources that you feel comfortable with, saying, well, if I'm putting my own hard-earned money into this company, at least I understand what's going on. So my biggest gripe about the retail market is not that they're investing, is they're investing sometimes for the wrong reasons, because they don't understand what they're doing. And I'm not advocating any one platform, but I have to say that Charles Savage at Easy Equities, who I have no affiliation with, I have no affiliations with anybody, I'm truly independent. I think that Easy Equities has done more for shareholder democracy and openness in this country in the last few years than any other platform that I have seen for as long as I've been in the stock market. They've made it accessible and they've made it cheap. But the problem with that brings is that people do not have a knowledge or the underlying information to back up that democracy to make a wise decision.
Yeah.
And I think many people are just basically throwing darts into a board, hoping to make money or following a trend.
Yeah.
And that to me can be a dangerous thing, particularly right now when we are in uncertain times. We have volatile international markets.
Yeah.
We have a war going on in Ukraine and Russia. We have high food prices. We have high energy costs. We have a very weak domestic economy with Eskom load shedding, a government which is flailing to decide how we can get growth and unemployment going in this country, and people randomly just buy shares without fully understanding what they do.
Yeah.
So my advice to anybody out there listening to this is do some basic research.
Yeah.
Not just look at one person on Twitter. There are many information sources. Understand what you're buying. And in many cases, buy stocks that perhaps you understand. If you shop every day at Pick and Pay, analyze Pick and Pay.
Yeah.
If you buy a particular brand of confectionery or cool drink, have a look at that company.
Yeah.
There's a very well-known investor in the United States called Peter Lynch, and he wrote a very, very good book in the 80s called One Up on Wall Street. And his advice to anyone was, if you're walking down a street and you see something that you know and understand, start to analyze it, because you understand the brand. You know Spar, you know Foschini, you know Pick and Pay, you know Coca-Cola, for example, you know South African breweries. Get to know the products that you understand. It'll make it much easier for you to then build up a knowledge base on the sector or stocks that you want to cover.
Oh, that's wonderful. That's the same story as me. I remember the first shares I ever bought were Mr. Price. And I bought Mr. Price shares because, most of you remember back in 2014, there was a trend of bucket hats. And everyone's buying bucket hats from Mr. Price. So when I started going into investment, the only thing that came to my mind was like, Mr. Price. I know Mr. Price. I wear Mr. Price. So that's how I was like, okay, let me get into it. And the more and more I started buying shares of companies that I know and understanding, and it makes it easier to study something that because you see every day. You see your mother using it, you see your uncle working there, you see the brand everywhere you move. It makes the feeling of researching, the feeling of wanting to know more and putting your money much more easier than to go buy a brand you have never seen before or reading about the company. And that's the most powerful point. I think you just mentioned that we had a bob or something.
That's the noonday gun that goes off in Cape Town at 12 o'clock to say it's 12 o'clock.
Oh.
So that's the gun going off on the hill. It's been doing it for over 100 years.
Oh, it's so like, okay, what's going on now?
There's no explosion here in Cape Town.
I'm like, yeah, boy. And I love that point. But I now want to move the conversation into the stock market, the JSE more specifically. We've been seeing a lot of companies delisting the JSE. There has been a trend of saying, hey, the JSE may be falling. And some people are saying, hey, the Cape Town stock market may be the new alternative. What's your feeling around the large number of delisting we're seeing in the JSE? Is it something that we need to be panicking about? And for you as someone who's an analyst, how you feel about the large delisting we're seeing in the JSE?
I love giving moments and snapshots of history. When I joined the JSE back in the mid-90s, there were 800 companies listed in the JSE.
Yeah.
As it stands today, there are less than 230, showing you how many companies have vanished off the JSE over the last 25, 30 years. Many of them have been in consolidations. There were over 100 gold companies listed. They're now consolidated down into Sibanye and Harmony and Anglo Gold, amongst others. Many companies go through cycles. Like in 1987, there was a huge listings boom in this country. Global stock markets were pumping and every family business listed. And then we had, of course, the year 2000 crash around the millennium, where all the companies in the tech space all went belly up. And we had another round of delistings. But the key thing that I see from a JSE is things go in cycles. I mentioned to you earlier that when I started work on the JSE in the mid-90s, the average valuation rating for a small cap stock was probably in the mid to high teens. We're talking 16, 17, 18 times. 10 years later, following the Lehman Brothers crisis, which saw the global financial pandemic and stock markets and economies globally tanked for a number of years, that price earnings ratio had fallen from 16, 17, 18 down to 10 to 12, showing you the derating of stocks. We then saw the emergence of private equity firms who realized they could actually buy good companies on listed exchanges globally at a very cheap price because institutional investors just were not interested. So the rise of private equity companies came in and they started spending hundreds of billions of dollars just delisting companies internationally because it was cheaper for them to buy a listed company than to buy a private company because the ratings were so divergent. Fast forward right now to 2022.
Yeah.
In 2020 and 2021, we saw a rapid delisting of companies from the JSE. Why is that? Simple. Because the lack of interest from institutional investors and the retail market had seen the price-earnings ratio of small to mid-cap companies fall from 10 to 12. At the height of the COVID pandemic in March 2020, you could buy really solid family companies that have been trading for 20, 30, 40, 50 years on PEs less than 4. Now, if you're a private equity company and you're seeing a lack of interest from the institutional and retail market from quality companies, you are going to go in, offer a premium to market to buy them out, and many cases institutions take the money and run.
Yeah.
So I have seen dozens and dozens and dozens of extremely well-run companies be taken up by private family companies, private equity companies or investment companies on price earnings ratio cheaper than it would cost you to buy a private company.
Yo.
The flip side of that is if you're a private company, seeing these JSE companies derate down to a 4, 5 or 6 times rating, why would you want to list your own company on the stock market when you're getting such a low valuation? You would just keep it in-house.
Yeah.
So we have seen a huge delisting boom, and we've seen no new listings because the valuations that the market ascribes to these family-owned companies does not justify their listings for staying private. We saw, for example, recently the Premier Milling listing coming out of Brait, which to me was overvalued.
Yeah.
That listing's been pulled. We've got Zeda Cars coming out of Barlow World, also on a very aggressive rating as an unbundling. So the market goes through cycles of delistings, listing, bundling and unbundling. We are in a process right now where the valuations are so low, we are seeing delistings, we are seeing no new listings, and we are seeing the private equity play in that space. I don't see that changing for quite some time until there's a significant re-rating of the Johannesburg Stock Exchange, and that sadly will not happen until this economy, both politically and economically, starts going back to a period of economic growth, political stability. Eskom needs to start working for us all. Luckily, we're in Devadakancha and we get no load shedding because we're on the hospital grid. So this podcast will keep on going out. But as we know right now, there are parts of this country suffering between 6 and 8 hours load shedding a day. That kills businesses. It kills creativity. It kills profitability, and it kills job creation. And until all of these small things are actually addressed by government and society as a whole, the JSE will never have a significant re-rating because there are bigger political and economic factors at play holding back people from creating wealth and listing companies.
Right now, you just made me think a lot. And I was like, there's some element as well I was not taking into account. But I also want to touch on the Cape Town stock market. We're sitting in Cape Town, by the way, so we have to touch on the Cape Town stock market. Is it all honey and sweet as people are selling it? Because I feel like, I don't know, for me, I feel uncomfortable with it. Every time I read up on some of the companies which are there, I feel like a lot of them are just gamblers. I may be wrong for this, but that's how I feel every time I read something about it. But for you as someone who you have the experience, you have the know-how of stock markets and analyzing companies. How do you feel about the Cape Town stock market? Is it just the hype, or is it truly going to be a stock market that we can see doing something big in the next few years? Because if the JSE is being affected by the politics, the Escoms, and everything that's happening in South Africa, a small stock market like the Cape Town stock market must be feeling it twice what the JSE is feeling.
Yeah, again, this country for many, many years only had one stock market, which was the Johannesburg Stock Exchange. The original stock market founded in the 19th century. And then in the last few years, because of the costs of operating on the JSE and its monopolistic tendencies, people got very disenchanted with wanting to list on the JSE, and alternative exchanges popped up. We had ZARX, we had A2X, we had 4AX, and many of them basically try to attract new listings or primary or secondary listings, and many didn't work. The one that has worked successfully is A2X, where JSE listed companies can have a secondary listing on the A2X, which has faster settlement and much tighter spreads, which means the difference between the buy and selling price is much narrower, which saves you a little bit of money whenever you trade.
Yeah.
Then 4AX became what is now known as the Cape Town Stock Exchange. Now again, a bit of history. I'm not this old, but during the Anglo-Boer War, going back over 120 years, the Johannesburg Stock Exchange was closed, but people still wanted to trade. So where could they trade from? They would trade from the old Cape Province. So the Cape Town Stock Exchange was founded for a number of months over 120 years ago, but it only lasted a very short while, and then it went back to trading in Johannesburg.
Yeah.
So the Cape Town Stock Exchange was resurrected probably 2 years ago by a group of black investors under the Bash umbrella, who are a very well-known investment holding company. They own the Business Day, for example. They own Business Day TV. They own the Financial Mail.
Yeah.
And they thought that the Cape Town Stock Exchange could be a platform for small companies who didn't want the regulation and red tape of listing on the JSE because they were too small to list. Now, the Cape Town Stock Exchange, based in Woodstock, is small. Its entire market value is probably less than 15 billion rand.
Yeah.
The number of shares listed are probably 12 to 15, and there is a debt capital market as well. There are, as you correctly say, a number of very, very small companies, which perhaps I would not recommend to the average retail investor because they're very illiquid, they're very specific, and you need to do a lot of work to put money into these small, teeny tiny companies. But saying that, they have attracted a niche of larger agricultural investment companies. Now, anyone who follows me on Twitter knows that I'm very fond of investing in food and agriculture because we all need to eat.
Obviously.
Farmers need to grow the crops that we turn into food that we eat every day.
Yeah.
And agricultural investment companies in this country have been around for over 100 years and they are solid, substantial businesses. So, for example, on the Cape Town Stock Exchange, there's one company listed called TWK, called the Transvaal Wattle Company. It sounds like a strange name, TWK. But they basically own forestry companies where they grow trees, which they chip, which are then ship overseas, then they make paper, which we use to write and print on.
Yeah.
That is a multi-billion rand revenue business. It made a profit recently of 500 million rand. Its market value is shy of 2 billion rand. There's a company based in Port Elizabeth, or Gugubecker as it's called now. Please excuse my pronunciation. I'm not from here.
We understand.
But I'm trying my best. And BKB is one of the leading companies in this country for lamb, meat trading, auctions, and mohair. It's a 20 billion rand revenue business with a market value of 1 billion rand. So inside the Cape Town Stock Exchange, there are these little gem businesses which are solid 100-year-old companies which are completely overlooked. Now, for example, TWK, which I mentioned earlier, you could have bought TWK shares 5 years ago for 7 rand. Trading today, 51 rand 50. It's been one of the best performing stocks of any stock on the JSE over the last 5 years because it's an agricultural business which has suddenly popped up from being OTC listed to having a primary listing on a known exchange and a secondary listing on the A2X. So in any exchange, there's always small companies that I would avoid. But on any exchange, there's always these little gem businesses which nobody covers, nobody knows about, which do fantastically well. And I've just given you 2 examples on the Cape Town Stock Exchange of TWK and BKB, who are multi-billion rand revenue businesses, very profitable, but they fly under the radar. So I would not diss the Cape Town Stock Exchange, but I would have to be a little bit more careful in my stock selection.
Yeah, but that's the thing is for me as well. Like, as much as the JSE is so big, it's easier for someone, especially a retail investor, to go in, read, and get the information they need to make a comfortable investment. While the Cape Town stock market, majority of the companies there, as you mentioned, are specific based, and they're so small that for someone who's sitting in Bloemfontein, someone sitting in Durban, it's very hard to get the direct information they need to fully understand that company and invest into it. But as you said, there's always gems, there's always diamonds to be found anywhere, but you have to do your research, you have to understand what you're investing into. At the same time, you need to be comfortable enough to know, I am putting my money into this because I have done all the steps needed into. I think that's the most powerful takeaway from the point that you are making. But now you're about to wrap up everything, and I want to ask you 2 questions. As you know, this series is proudly sponsored by Centrix. I need to know ETFs. As much as you are not an ETF big investors, but I want to know in terms of the ones, I'm not sure if you fully know all the ones that Centrix has, but in terms of the one that you're familiar with, which are the top 2 ones from Centrix that you say always catches your eyes when you look into ETF once in a while?
Again, I've mentioned on my platform, as I'm sure you have, that one of the easiest, simplest, and cheapest ways to build long-term wealth is to have a regular debit order into an ETF, be it domestically or perhaps even internationally, to start building up your little nest egg. You know, at the end of the day, South Africa is a small economy. We are less than 0.5% of a global economy. And I tell people, would you really want to have all of your money in a country like ours, which has known problems? You would want to have some money offshore. One, for diversification of your asset base, and secondly, to protect your currency. Because let's not forget, the rand has not exactly been the most stable currency over a number of years. And in fact, you would have made more money this year putting your money in an offshore account, earning no interest and just playing the currency than actually investing offshore. So to me, you have to be in the Satrix top 40 to get exposure to all the big companies in this country, which is where most people tend to track. But you also then need to have some form of basket of stocks offshore, be it either the MSCI index or one of the European indices, or perhaps even the S&P 500 in the US. So that you as an investor don't have all your eggs in one basket, because if something were to happen to this country, you know, God forbid, you do not want to have all of your money sitting in the JSE when perhaps you could have diversified your risk to protect your wealth and your children's wealth and your family's wealth going forward. So my split would be, if I had to have an optimal split, depending on your age, I always tell young investors, invest 100% of your money into equities, because you have time on your side. The power of compound, power of dividends means that in 50 or 60 years, no matter the bumps that we see in the stock market, in the history of time, a stock market crash is nothing more than a small road bump into the ascension of the stock market.
It's going upwards.
And then depending on your age profile, you then start mitigating your risk by adding in cash, bonds, and other markets to modify your risk. So right now, as a young person who would be listening to this program, invest in equities. Have a nice split domestically, but always have some money offshore to protect yourself. So I would probably say a 60 to 70% allocation locally and 30% offshore. And as you start moving into your 20s and 30s and 40s, change that mix. Start adding in bonds, start adding in cash, start building in maybe property, because you need to protect your capital once you've started to make it. But you have to make it first. So to use my favorite expression, you have to go balls to the wall, invest money in equities when you're young, and then as you've built up your wealth, you then need to diversify to protect it. So those would be my recommendations. You know, like an Aussie 40, and then an offshore MSCI fund or a European fund or an S&P 500 for mitigation of risk.
Yeah, that's so true. That's so true. And guys, do remember that all the ETF we're talking about are available on the Centrix app. Download it to ensure that you're able to diversify your investment international or here in South Africa. But now to conclude the entire conversation, 2023, what can you expect from Small Talk Daily, from yourself and your work? That you can say, okay, you are planning this and you're willing to share it in public. What can we expect from you going to 2023?
Ivan, if I had a crystal ball and I could look in right now for 2023, I would be a very rich man and I wouldn't be doing podcasts. What we've seen this year, unlike 2021, which we saw a fantastic run in small to mid caps, they were up north of 50%. This year, small caps continue to outperform the broader JSE All Share and the mid cap index, but we've only seen growth literally of a matter of a few percentage points. So you'd still have made money compared to losing money investing in the broader market. But what we saw this year is a global instability, the rising cost of living in terms of food price inflation, and more importantly, the rapid cost of energy has had a dramatic impact on industry globally, has seen profit growth slow globally, and we also have political instability in many countries globally. We have the Russian-Ukrainian war showing no sign of ending, and it could get a lot worse depending on how President Putin wants to escalate that situation. And the main factor that drives stock markets globally is sentiment. Sentiment regarding profitability of companies on the exchange, the rating of those companies. So if you make less money and the ratings start to derate, the values of stocks start to fall, and of course political instability. But in this country, we're living in South Africa, a country that is dear to both of our hearts.
Yeah.
We have got the ANC's elective conference going on in the next week. We have no idea what's been going on behind the scenes regarding President Ramaphosa and his difficulties. We have Eskom currently escalating load shedding, which is having a significant impact on production in this country.
Yeah.
That will then flow into the profitability of companies' profits into next year and the added costs of now operating in this country. And I love using examples. When the country's largest chicken producer, like Astral Foods, in its results 2 weeks ago, said that they have just spent 200 million rand putting in 8 generators at their biggest processing plant in Standerton, where they have to provide water because the local municipality in Lekwa can't provide reliable electricity or water. That cost has to be borne by the company, which ultimately then is passed onto the consumer, who has to pay more for the basic protein in life, which is chicken. The consumer is not seeing any wage growth. There's no employment growth. Many are living on social grants, which is not going up that much. And, something has to give. So I would think in 2023, we are going to be seeing companies coming out, I think, with profit downgrades and perhaps guiding the markets lower regarding profitability. That'll then have an impact on their share prices. And my job as an analyst covering small to mid caps is to try and find those companies which perhaps have a greater moat around their business or perhaps have greater resilience in their revenue and their profitability, which would protect them more from other companies. So where would I be looking in 2023? Where I have been for the last couple of years. Certain agricultural companies have a moat because people still need to eat. They may not be able to afford to buy as much, but you still have to grow the mealies, you still have to grow the canola, the soya, the potatoes, the cabbages to give people food. So I would still stick to agriculture. Stick to the better quality small to mid caps. I'm working right now on a note upstairs, which will be out later today, and probably to the wider media at the end of the week, on investment company Sabcap. Now, Sabcap year to date is up 50%. It's a small business investing in other companies, so you're relying on the expertise of one very well-known entrepreneur to invest your money into companies that he understands better. So try and get a company or invest in companies which have resilience or have experts running them, because then they're doing the hard work for you. I think 2023 will be a very difficult year because we have no idea politically what's going to happen after the ANC elected conference. We have no idea if Eskom are going to be, sorting out their power problems. And until those two great unknowns are actually alleviated, I think the market will be very cautious. And the small cap market for the last month or so has taken a bit of a backseat because when times are difficult, institutional investors, there's a flight to safety. Safety generally means they tend to buy large blue chip companies with rand hedge exposure because they can protect themselves. And as such, the small cap market tends to be ignored. When things are ignored, valuations tend to come under pressure. And that's when people like me spot gems.
Oh, silly diamonds.
And unlike me, I'm going to give you maybe an idea or two. There are many companies right now trading in the small cap space on PEs of 2s, 3s, and 4s. You could not buy a private company on a 2, 3, and 4. And I'm going to give you one example, just as one tiny little gem on a report that I'm writing after Sabcap. I'm not sure when your podcast is going out, but when it does go out, this report will have been published. The IT and hardware company Mustec. Everybody knows the Mesa brand of PC. They aren't doing that well currently, but this is a company trading at about 14 Rand 50. They have a net asset value of 24 Rand a share. Its price earnings ratio is 4 times. You could not buy or create a company like Mesa with its international supply chain of manufacturing technology, laptops, PCs, power inverters, solar panels, etc., on a PE of 4. It is profitable. It is doing extremely well. And on a PE of 4, with the founder sadly having passed away fairly recently, David Can, who was a friend of mine, perhaps the company is ripe for a takeout. Why should a family who owns a business following the passing of a much-loved founder say, you know what, We're trading at a huge discount to net asset value. The market doesn't care who we are. We're in a PE of 4. Shouldn't we take this company private? Even if a company doesn't go private, it makes nice earnings, it pays good dividends, and it's buying back its own shares. And there's one example of a small company with a market value of 800 million rand, which could perhaps next year be one of those little gems that you'll remember from this podcast saying, I heard something about Muscat, and now it's potentially happened. It may or may not, but there's one idea as to a potential story that could play out next year.
Oh, that's so wonderful. I love the fact that you always give practical examples. You don't want to be there and you just make it very clear, very open. I love to say thank you so much for, number one, always being open to sharing your information, sharing your experience, sharing the little bit gems that you see in your work with the general public, and also simplifying. Because one thing I wanted to do with this podcast, with these videos and everything, let's bring South Africans that are willing to give information out to the average South African. But let's be honest, majority of our South Africans are not educated. They're not well experienced with dealing with stock market as other people are. But the fact that people like yourself, people like Sol Ferry, Esther, and all the guests that I've invited to this series, sitting down and just saying, number one, thank you for your work. Number two, thank you for sharing your work. And number three, thank you for simplifying it for the average South African who's not well educated, not well informed, not well experienced in this field, but want to invest, want to buy shares. But as you said, ownership also investing is a form of dignity to the people of South Africa. And for people like yourself to give back and share that experience, that's the way for me to say thank you. And so keep on working, keep on sharing that information because we need it. The way I started investing was when I went to Twitter and I saw people like yourself sharing that information. I was like, okay, let me also learn what they're saying. Let me try to also understand the jargon. And I was like, no, there's no jargon to understand because they're simplifying it in a way that for me at that time, I was a high school student in a township, just with a Samsung phone. And I was able to understand what you're saying. And that's how I got more and more and more invested into stock investment. That's why we're even sitting right now. So number one, thank you for that. And also to all the listeners, I hope the entire episode was helpful. The entire information was shared. Will help you invest more. Buy more shares. Buy more into ETFs. Buy more into whatever form of investment that you find attractive to you. But as always, guys, thank you so much to my sponsor, Centrix. Do ensure to download the app. Do ensure that you look into all the ETF, all the investment product that they have. As well, guys, do ensure to hit the like button, hit the subscribe button, and leave me a comment. Tell me what you thought about the entire interview. As always, guys, I am Ivan Spencer Sambo, your student investor. And thank you so much for watching.